Federal Reserve just made an announcement that's going to have major implications for every American's wallet. Starting December 12, 2024, the Fed is turning the money printers back on. Now, if you've been following economic news over the past few years, you know that the Fed has been trying to fight inflation by tightening monetary policy, raising interest rates, and reducing their balance sheet. But that's all about to change, and it's happening much sooner than almost anyone predicted. Here's the interesting part, though. The Federal Reserve isn't calling this quantitative easing. They've given it a new name: Reserve Management Purchases. It's essentially a rebrand of the same monetary expansion policy, but with a name that sounds more technical and less alarming to the general public. However, when you look at what's actually happening, it's balance sheet expansion. It's money printing. It's the same fundamental action that pumps more dollars into the financial system, just with different branding. So let's dive deep into what the Federal Reserve announced, what it means for the economy, and why this matters to you regardless of whether you're an investor, a saver, or just someone trying to make ends meet in an increasingly expensive world. At their most recent Federal Open Market Committee meeting, which concluded today, the Fed made two significant announcements that are going to shape monetary policy going forward. The first announcement was about interest rates. The Federal Reserve decided to cut interest rates by 25 basis points, which is 0.25%. This brings the federal funds rate down from a range of 4.5% to 4.75% down to a new range of 4.25% to 4.5%. Now, this is continuing the trend of rate cuts that began earlier this year, as the Fed has been trying to engineer what they call a soft landing, bringing down inflation without triggering a recession. But the second announcement is even more significant for the long-term trajectory of the economy. The Federal Reserve announced that starting December 12th, they will begin purchasing Treasury securities, specifically Treasury bills, at a rate of $40 billion per month. Let that number sink in for a moment. $40 billion every single month. And here's what makes this even more noteworthy. There is no announced end date for this program. The Fed's official statement says they will make these purchases as needed to maintain an ample supply of reserves on an ongoing basis. According to the statement released by the New York Federal Reserve, these purchases will focus on shorter-term Treasury securities. The language they use is careful and technical, but the bottom line is straightforward. The Federal Reserve is expanding its balance sheet again, which means creating new money to purchase government debt. Now let's put this in perspective with some historical context. After the 2008 financial crisis, the Federal Reserve engaged in multiple rounds of quantitative easing, massively expanding their balance sheet to support the economy. Then came the COVID-19 pandemic in 2020, and the Fed went into overdrive, expanding the money supply at an unprecedented rate. This contributed significantly to the inflation we've all been experiencing over the past few years. Prices for everything from groceries to housing to cars skyrocketed. In response to that inflation, the Federal Reserve began raising interest rates aggressively in 2022, and also started reducing their balance sheet through a process called quantitative tightening. They were letting their holdings of Treasury securities and mortgage-backed securities mature without replacing them, effectively taking money out of the system. Many economists and analysts believed this tightening cycle would continue well into 2025 or even 2026, before the Fed would consider expanding their balance sheet again. But here we are in December 2024, and the Fed is already reversing course. The timeline moved up dramatically. Initial projections from various market analysts suggested the Fed wouldn't restart any form of balance sheet expansion until sometime in 2026. As we got deeper into 2024, some analysts revised their estimates to early 2026. But now we're looking at December 12, 2024, just days away. This represents a significant acceleration of the timeline, and it raises important questions about what the Federal Reserve is seeing in the economy that's prompting them to act sooner rather than later. Along with these policy announcements, the Federal Reserve also released their summary of economic projections, which they only do 4 times per year. These projections give us insight into how the Fed sees the economy evolving over the next few years, and there are some fascinating numbers in this latest release. Let's start with GDP growth. Back in September, just a few months ago, the Federal Reserve projected that the U.S. economy would grow by 1.8% in 2025. In today's release, they've revised that projection upward to 2.3%. That's a substantial increase. We're talking about an additional 0.5 percentage point of growth, which in an economy as large as the United States represents hundreds of billions of dollars in additional economic activity. The Fed is now significantly more optimistic about economic growth than they were just 3 months ago. When it comes to unemployment, the Fed's projections show the unemployment rate ending 2025 at around 4.4%. This is relatively close to where we are currently, and it didn't change much from their September projections. Essentially, the Federal Reserve is saying that they expect the labor market to remain relatively stable. They're not projecting significant job losses, nor are they projecting that unemployment will drop substantially. The implication here is that the combination of rate cuts and this new reserve management program will prevent further deterioration in the labor market while keeping it roughly in equilibrium. Now here's where things get really interesting and frankly a bit confusing. The Federal Reserve is projecting that inflation will be lower in 2025 than they previously forecast in September. Think about that for a moment. They're projecting stronger economic growth, GDP up significantly from their previous forecast. They're projecting a stable labor market with low unemployment. They're cutting interest rates, which makes borrowing cheaper and generally stimulates the economy. And they're injecting $40 billion per month into the financial system through Treasury purchases. Yet somehow they expect inflation to be lower than previously projected. This seems to contradict some basic principles of economics. Generally speaking, when you have strong economic growth, low unemployment, low interest rates, and monetary expansion, you get inflationary pressure. More money chasing a similar amount of goods and services tends to push prices up. The Federal Reserve didn't provide a particularly compelling explanation for how they square this circle, how they expect all these stimulative factors to coexist with lower inflation. When Fed Chair Jerome Powell was questioned about this during the press conference, his explanation centered on productivity. He suggested that the American economy is experiencing higher productivity growth, possibly driven by technological advances including artificial intelligence. The logic goes something like this. If workers are more productive, they can produce more goods and services with the same amount of labor. This increased supply can offset increased demand, keeping inflation in check even as the economy grows and the money supply expands. Powell pointed out that productivity has been structurally higher for several years now, running at around 2% annual growth. If this continues or accelerates, the economy can sustain higher GDP growth without generating the same amount of inflation that such growth would have produced in the past. Higher productivity also enables real wages adjusted for inflation, to rise over time, which is ultimately what improves living standards. But here's the thing. Banking on productivity increases to offset the inflationary effects of monetary expansion is somewhat speculative. Productivity can be volatile and difficult to predict. And while AI and other technologies certainly have transformative potential, that potential takes time to fully materialize across the entire economy. So there's a legitimate question about whether the Fed's optimistic scenario, strong growth, low unemployment, lower inflation, all at the same time, will actually play out as projected. Another fascinating element of the Fed's projections relates to future interest rate policy. According to the summary of economic projections released today, the Federal Reserve expects to cut interest rates only one more time in all of 2025, just one 25 basis point cut for the entire year. After today's cut and presumably that one additional cut next year, the Fed is projecting that they'll hold rates steady for the remainder of 2025. Now there's significant skepticism about whether this projection will hold up. Market participants often doubt the Fed's longer-term projections because conditions change, and the Fed has to adapt to evolving economic realities. But there's another factor that makes this particular projection even more uncertain: leadership transition. Jerome Powell's term as Federal Reserve Chair ends in May 2026. That means we're just a few months away from a potential change in leadership at the most powerful central bank in the world. The president will nominate a new Fed chair, subject to Senate confirmation, and that new chair could have substantially different views on monetary policy. If the new Fed chair has a more dovish orientation, meaning more willing to keep rates low and maintain accommodative monetary policy, then this projection of just one rate cut in 2025 could prove to be far too conservative. History shows us that leadership changes at the Federal Reserve can bring significant policy shifts. Different chairs have different economic philosophies, different risk tolerances, and different priorities in balancing the Fed's dual mandate of price stability and maximum employment. So while the current Fed is projecting minimal rate cuts next year, the reality could be quite different once new leadership takes over. Now let's talk about the justification the Federal Reserve is giving for this $40 billion per month Treasury purchase program. During the press conference, a reporter asked Chair Powell a very direct question. Why are you starting with such a large amount? $40 billion per month is not a small number. What's driving the need for this level of reserve management? Powell's answer focused on a specific date, April 15th. If you're American, you know what April 15th means, tax day. It's the deadline for most Americans to file their federal income tax returns and pay any taxes owed. Powell explained that on tax day, something happens in the financial system. Reserves drop sharply but temporarily. As people and businesses pay billions of dollars to the federal government, money flows out of the banking system and into government accounts, reducing the level of reserves that banks hold. The Federal Reserve wants to ensure that there's an ample supply of reserves even during these temporary dips. Their framework is designed to maintain adequate reserves at all times, to ensure the smooth functioning of the financial system. So part of this $40 billion per month is about building up reserves in advance of tax day in mid-April, when there will be that temporary drawdown. But that's not the entire story. Powell also mentioned what he called secular ongoing growth of the balance sheet. This is the baseline expansion that's necessary just to keep the ratio of reserves to the overall economy constant. As the economy grows over time, as the banking system expands, as the amount of currency in circulation increases, the Federal Reserve needs to expand its balance sheet proportionally just to maintain the status quo. Powell indicated that this secular growth alone requires approximately $20 to $25 billion per month. So if you do the math, roughly half to slightly more than half of this $40 billion monthly purchase program is the baseline that would be needed anyway for secular growth and seasonal tax-related fluctuations. The rest represents an additional layer of reserve buildup. And notably, the Fed indicated that after a few months, the pace of purchases is expected to decline somewhat. But there's considerable skepticism about whether that will actually happen. Because once central banks start expanding their balance sheets, they often find it difficult to stop. It's been compared to an addiction. Once you start, you need more and more to achieve the same effect. Now let's address what might be the most important question. What does all this mean for inflation? The Federal Reserve is adamant that they remain committed to their 2% inflation target. Chair Powell reiterated this commitment multiple times during the press conference. But when you look at the actual policy actions, there's a disconnect between the rhetoric and the reality. Consider what's happening right now. Inflation has been rising in recent months. It had come down significantly from its peak of over 9% in 2022, falling to around 3% by mid-2023. But progress has stalled, and some measures of inflation have actually ticked back up. Core inflation, which excludes volatile food and energy prices and is what the Fed focuses on most closely, has been stubbornly above the 2% target. And what is the Fed doing in response? They're cutting interest rates, making borrowing cheaper and stimulating the economy. They're about to start creating $40 billion per month in new money to purchase Treasury securities, directly expanding the money supply. These are not the actions of a central bank that's laser-focused on bringing inflation down. These are the actions of a central bank that's more worried about economic growth and the labor market than about inflation. During the press conference, a reporter asked Chair Powell a pointed question about this very issue. The reporter noted that Americans overwhelmingly cite high prices and inflation as their number one economic concern. Poll after poll confirms this. People are frustrated and stressed about the cost of living. Everything from groceries to rent to insurance to cars costs significantly more than it did just a few years ago. So why, the reporter asked, is the Fed prioritizing the labor market, which seems relatively stable, instead of Americans' number one concern, inflation? Powell's response was revealing. He acknowledged that the Fed hears loud and clear from their network of contacts across the economy that people are really feeling the pain of high costs. But then he made an important distinction. He pointed out that much of what people are experiencing isn't about the current rate of inflation. It's about the cumulative effect of the high inflation we experienced in 2022 and 2023. Even if inflation is running at 3% now instead of 9%, prices are still much higher than they were a few years ago, and they're not coming back down. Once prices rise, they tend to stay at those elevated levels even if the rate of increase slows down. Powell's solution? Keep the labor market strong so that wages continue to rise. The theory is that if people are employed and earning good wages, and if those wages are rising faster than inflation, then over time people will adjust to the higher price levels. It won't feel as painful because their incomes will have risen to match. This requires several years where real compensation, wages adjusted for inflation, is significantly positive. Nominal wages need to be growing faster than prices for people to start feeling economically healthy again. It's a reasonable economic argument, but it does reveal the Fed's priorities. They're essentially accepting that prices are going to stay high, and they're trying to make that more bearable by ensuring people have jobs and rising incomes. They're not actually trying to bring prices back down to where they were. That would require deflation, which comes with its own serious economic problems. Instead, they're trying to manage the transition to a higher price level by supporting wage growth. But here's the risk. The policies they're using to support the labor market and wage growth, low interest rates and monetary expansion, are also inherently inflationary policies. There's a real possibility that in trying to keep the labor market strong, they end up reigniting inflation, which would defeat the purpose. You can't really win the affordability battle if wages are rising 4% per year, but prices are rising 5% per year. People would still be falling behind. This is the fundamental tension the Federal Reserve is trying to manage, and it's not at all clear that they can thread this needle successfully. The historical track record of central banks trying to orchestrate soft landings, bringing down inflation without causing a recession, is mixed at best. More often than not, bringing down significant inflation requires a period of economic pain. Let's talk about what balance sheet expansion really means and why it matters. When the Federal Reserve purchases Treasury securities, where does it get the money to buy them? This is a crucial question, and the answer is, the Fed creates the money. It's not taking money from tax revenue or from savings. It simply credits the account of the seller with new bank reserves. This is what people mean when they talk about printing money. The physical printing of currency is a small part of it. The real money creation happens electronically when the Fed expands bank reserves. These newly created reserves flow into the banking system and eventually into the broader economy through bank lending and other mechanisms. More reserves in the banking system means banks have more capacity to lend. More lending means more money circulating through the economy. And more money circulating through the economy, with a relatively fixed amount of goods and services to purchase, creates upward pressure on prices. This is the most basic relationship in monetary economics. Now, the Federal Reserve and many mainstream economists will argue that this relationship isn't as direct or as simple as it might seem. They'll point out that money creation doesn't automatically translate to inflation if the velocity of money is low, if people and businesses are holding on to money rather than spending it. They'll note that increased reserves don't automatically lead to increased lending if banks are cautious, or if there isn't sufficient demand for loans. And they'll emphasize that productivity increases can expand the supply of goods and services to match increased money supply, keeping inflation in check. All of these points have merit, and monetary economics is indeed complex. But the fundamental principle remains: expanding the money supply significantly while the economy is already at or near full employment is playing with fire from an inflation perspective. And that's exactly what the Fed is about to do. It's worth noting how investors and markets are responding to all of this. Many sophisticated investors have been increasing their exposure to what are called inflation hedge assets. Gold and silver, which have been traditional stores of value for thousands of years, have seen significant interest. Gold prices have been hitting record highs. Real estate, particularly in certain markets, continues to be viewed as an inflation hedge because property values and rents tend to rise with inflation. Some investors are looking at commodities more broadly. Others are considering Treasury inflation-protected securities, or TAPIs, which are government bonds specifically designed to protect against inflation. And of course, some portion of investors look to cryptocurrencies like Bitcoin as a potential inflation hedge, though that's far more speculative and controversial. The common thread among all these investments is that they represent real assets or claims on real assets, rather than just paper currency whose value can be eroded by monetary expansion. When investors see central banks expanding money supply aggressively, they often move toward these types of assets to preserve purchasing power. So where does all this leave us? Let's summarize the key points and think about what this means going forward. The Federal Reserve is cutting interest rates and starting a $40 billion per month Treasury purchase program on December 12th. This represents a significant shift in monetary policy, happening much sooner than most analysts expected. While the Fed frames this as reserve management rather than quantitative easing, the practical effect is the same: balance sheet expansion and money supply growth. The Fed's economic projections show optimism about growth, but also show some internal contradictions. They're projecting stronger GDP growth and stable employment alongside lower inflation, even as they implement stimulative monetary policies. Their explanation relies heavily on productivity growth, which may or may not materialize to the extent needed. The justification for these policies centers on maintaining adequate reserves in the banking system, particularly ahead of tax day, and supporting the labor market. The Fed argues that keeping people employed with rising wages is ultimately the best way to address concerns about affordability, even if it means accepting that prices will remain elevated. There's significant uncertainty about what happens next, particularly given the leadership transition coming in May 2026. The current Fed projects only one more rate cut in 2025, but that could change dramatically under new leadership with different policy preferences. From an inflation perspective, the Fed is taking actions that are historically associated with inflationary pressure, while simultaneously claiming commitment to their 2% inflation target. Whether they can actually achieve lower inflation while stimulating the economy remains to be seen. And there's plenty of room for skepticism. For individuals, this environment creates both challenges and opportunities. The challenge is that purchasing power may continue to erode if inflation stays elevated or reaccelerates. The prices you're paying now for everyday goods and services are likely to stay high, or potentially go higher. The opportunity is in understanding these dynamics and making financial decisions accordingly, whether that means adjusting your budget, negotiating for higher wages, or considering investments that might preserve value in an inflationary environment. The key dates to keep in mind are December 12th, when the Treasury purchases begin, April 15th, tax day, which the Fed cites as a key reason for building up reserves, and May 2026, when we'll likely see new leadership at the Federal Reserve that could substantially alter the policy trajectory. This is a pivotal moment in monetary policy. The Federal Reserve is making consequential decisions that will impact the economy, financial markets, and ultimately every American's financial well-being for years to come. Whether you're a saver, an investor, a borrower, a business owner, or just someone trying to make ends meet, these policies will affect you. Stay informed, understand the implications, and make decisions that align with your personal financial situation and goals. The money printing is starting again, and that's going to have ripple effects throughout the entire economy.